Good morning, everyone. This is Maureen Lefkins with Underwriters Marketing Service. I want to just cover a few housekeeping items. This session is intended for insurance professionals and advisors, not for consumers. And although all of your lines are muted, this session is being recorded, and if you do not wish to participate in that, this would be a good time for you to exit the call. There is a chat and question section on the right-hand side of the webinar screen. Please feel free to put your questions there, and our speaker will answer as many as he can, or we will be in touch with you later after the session to answer your questions. Bob Donnelly is our speaker today, and he comes with a long list of designations after his name. He has been supporting Underwriters Marketing and our producers in advanced sales for nearly 10 years now. And he is one of the most successful individuals we know. A few weeks ago, he introduced a session regarding very high-end client solutions with his associate, Michael Moore. Today, however, he's going to introduce a similar topic, again, using a strategy that UMS has been given proprietary access to, but for a little bit less high-end, probably more for your average, let's say, clientele. Bob, like UMS, and with UMS, is always there for you. So make sure you jot his phone number down if he gives it out. Bob, it's all yours.
Thanks, Maureen. It's a pleasure to have everybody jump on this call. My apologies for last week's technical difficulties. I think I'm a pretty good planner, but a lousy technician, so we all know our weaknesses. But with that in mind, I'm hoping to plant an idea or two and you'll end with, oh, I got this guy. I need to talk to him about this. Or I got this lady who's successful and she's got some issues relative to planning capabilities. So with that in mind, let's begin. We're going to deal with premium financing. Those two words have such a broad application. And we're going to talk about the big picture, the more classic premium financing in the beginning of this presentation, but then we're going to drill down to it, basically to a much larger, to 100 times larger than as you're thinking of. And I'm going to give you some catchphrases you need to use in engaging either existing clients or prospects to work with you in this arena for proper planning. So let's begin. Last month, I introduced you to the premium financing, and there was a couple things I wanted you to walk away with. As a little reminder, we're talking about discovering problems, providing solutions, and using leverage as one of those tools you could use, whether it's for estate planning to pay estate taxes, whether it's for legacy planning, meaning leaving money to the second or third generation beyond you, or whether it's just some charitable obligation. So how do you do that? Rather than doing the classic life insurance model where you say, I'm going to buy $1 million, I'm going to buy a $10 million policy, and I'm going to pay this much, and when I die, my heirs, per the direction of either a trust or individual beneficiaries, will get the money. However, rather than writing that check for $100,000 or $150,000, let's write a much smaller check and use leverage. That whereby you can get 2.5 to 3 times leverage for your money. That's where it comes in. And we can keep the assets in their preferred investments. We're not asking you to sell anything. Think about that. Where does the money come from to fund the life insurance premium? Well, rather than having it come from your stock portfolio where you have to sell or liquidate to create the cash to pay the premiums, let's keep them over there in their terrific returns and borrow against it. So we can keep preferred investments in place. And that will enable you to grow your net worth as it continues to grow. On the one hand, the insurance is being backed through a premium financing model. Put those combinations, that's premium financing. As a review, last time we talked about, this was one of my favorite cases, this was we're going to do generational planning. Generational planning is looking for that next generation, obviously. It's not meant in the classic tax situation. We're doing estate taxes. No, we're doing generational planning. How do we leverage an existing situation? Well, in this particular case, this is a wealthy family. They've got a $23 million policy on mom and dad inside the trust. And the trust has and that policy has $7 million of cash value. We've just identified the targeted asset that we can use for the proper leverage for premium financing. That 7 million is there. So where do we go from there? Here's an example of that. So with all those numbers coming through, look to your far right, or better yet, let's look at H, column H. What is the payback in years 19 will pay back the loan, but more importantly, in column G, what's the annual outlay? I don't know about you, but I don't know. I woke up a day older than I was yesterday. So with that in mind, my eyes aren't what they used to be. So here's a quick summary of that. The annual outlay for the son, age 40, is zero. That's a good deal so far. He's insured, and his projected tax-free income is 5.5 million. He begins, and by doing that from ages 60 to 90, 30 years of distribution, 30 times 500 means we're going to get 15 million of tax-free income. I ask you, what did we pay for this? Zero. Ultimate leverage. And in doing so, he ends up dying at age 90 and leaving 35 million behind. Now, here's a question I asked for you. What if he didn't take that income because he didn't need it because he had other income from other investments? Well, his death benefit would be north of $90 million if he didn't take the cash of 15 million along the way, even the legacy for second and third or fourth generations within that family. So you end up with, if you do the model as presented, I got 15 million of income, leaving 35 million behind for a total value of 50 million with no outlay. His peak collateral, how much exposure does he have? His peak collateral is in year 6 of only 650,000, because we're putting enough cash in there. The cash is growing, and the crossover point is 650 when it's at its highest point. And by year 12, we have zero collateral required to make this policy self-sufficient. So it's a great idea. This is not estate planning as you're thinking about it. Classic estate planning is, oh, I got a guy. Always starts that way. I got a guy. He's worth $30 million under current law. We got 22 million exclusion as a husband and wife. But in 2026, we've got a $10 million tax bill. So let's buy life insurance to prepay that estate tax liability. This is a different motivation here. This is all about using mom and dad's trust and the cash value in the trust so that the son and the daughter can be receiving $500,000 of tax-free income while still having a death benefit in play. That's the review from the last time we met. Now let's change that differently. We have all clients out there have different ways of looking at the world. So one of this would be legacy planning. It's like, well, geez, will I be remembered? And the answer is maybe, maybe not. Well, put it to you this way. There's a little school down in North Carolina. Let's see, they play North Carolina. They play North Carolina State. Does anybody recognize the name of that third school in North Carolina? You're thinking Duke. Yes. Well, the Dukes were very rich, and therefore the family Duke put in lots of money way back when and established a college, a university. So therefore their name lives on in perpetuity. We can't quite go that large, but the point of the story is what? Some people want to be remembered and they want to create a legacy. So here we have a male age 56, different motivations from the first clients that we were looking at. Here, he's a standard non-smoker, and we're saying, okay, if he could leave $10 million behind to a charitable foundation, and by the way, he's going in, this is a real life case, and he's partnering with another associate of his, so they're going to leave 10 million each to fund this foundation that'll have their name on it, so they can leave a little something behind, as they like to say. So it's a $10 million death benefit. and he's only going to fund $20,000 per year for how many years? Quick, guys, let's do the math here. For 10 years, he's going to set aside $200,000 to leave $10 million behind or so. So here's one way of looking at it, because people always ask the question, what if, what if, what if I do it this way, I do it this way. This is a comparative model that we're having difficult reading, because I don't know about you, but my eyes aren't as sharp as I like them to be. But at the end of the day, look at the death benefit in the middle of that. It says death benefit, go all the way down to the bottom of the page at age 90. What is the death benefit having put in 200,000? Well, the projected death benefit is 8.5 million. Look to the far right, end of year value. That's the alternative fund, worth 17 million. I point those two numbers out to you. I'm not here to give you a complete detailed explanation of this proposal, but letting you know the mechanics behind it all. So let's look at a better view of this proposal. Here we have it. He said, okay, the life insurance guy comes in and says, hey, we can give you $10 million. It's going to cost you $154,300 a year for the rest of your life. And in doing so, you're going to be insured for $10 million. Old school, very basic planning, it works. On the other hand, he's going to pay that for the next 35 years. So by the time he's at age 90, when he passes in our model, somebody's going to collect the $10 million. But wait, he had to pay over $5 million for his beneficiaries to receive his charitable foundation to receive the $10 million. That's one way of doing it. So the legacy benefit under the life insurance model is $10 million. What if we combine a premium financing model with life insurance, but do it a little different way? We're all insurance agents. What has been the mantra of everybody there in the insurance business when you were trying to sell permanent insurance? Hey, buy term and invest the difference. I got a different model. Let's do premium financing and invest the difference. So that in year one, he puts up his 20,000. He does the 20,000 for the next 10 years. So in the next 10 years, he's put out $200,000. And yes, the death benefit's a little over $8 million at age 90. But look, the separate account. This is the money he did not send into the insurance company. He held it aside in his separate account. It earned between 6 and 7% interest. So the money that he did not send into the insurance company has grown to 17 million. So therefore, we end up having his trust, his charitable foundation receiving $25 million, and his total outlay was 200,000 plus the money he set aside and saved. So in the end, you want 25 million with your name on it? Do you want 10 million? The point of this story is I did not create a targeted death benefit using life insurance as a scalpel to create exactly this death benefit. But he's okay with somewhere between $7, $8, $9 million of death benefit and the leftover money because of premium financing being left behind to fund them. That's just one way of doing legacy planning. Now, I want you all to raise your hands out there and say, okay, how many people do I know that would fit those first two situations? They've got a net worth of $10 million. They're interested in legacy planning. They're interested in leaving millions behind. I suspect that you may have that list of clients you can call on, maybe on one hand, two hands. Hopefully it's on more hands than 10. But what is it not? The second question is, how many clients of yours or prospects do you know, or friends that you know that have a 401k? I think that number went up by 100. If you've got 5 people in the premium finance, you probably have 500 Kaizen people that can use the Kaizen combo because they have a 401k. Who has a 401k? Think about that. What clients have that? We're going to get into that as an example. But before we do that, let's take a look. Now, this is a recorded presentation. So in respect to all compliance people out there, allow me to read this. This presentation is for general education only and not intended to be construed as investment, tax, legal, or financial advice. Attendees should seek the the assistance of a professional prior to implementing any of the ideas and strategies taught or discussed in this presentation. Hypothetical or actual historical returns contained in this presentation are for informational purposes only and not intended to be an offer, solicitation, or recommendation. Rates of return are not guaranteed and for illustrative purposes only. Kaizen utilizes an insurance product as a funding vehicle. Projected rates do not reflect the actual or expected performance with any example, insurance or financial products. Past performance does not guarantee future results. Investment advisory service offered through Alpha Advisors Alliance, LLC, a Pennsylvania, New Jersey registered investment advisor. Insurance services offered through Alpha Financial Companies, Alpha Advisors Alliance, LLC, and Alpha Financial Companies are affiliated. That being said, the compliance people are smiling. Introduction. Before we get into the 401k combo, let's do a quick review of 401ks, the benefits, and why people like them so much as retirement savings vehicles. To begin with, the max contribution is $19,500 up to age 50. Over age 50, you can put an additional $6,500 into it, making your total contribution $26,000 and above every year from you're 50 and older. You will fund with pre-tax dollars. That's why people like doing that. They say, oh, don't pay me $200,000, pay me $190 and $10,000 over here before I get touched. Save that over here or whatever amount up to $19,500 if you're under age 50. Employers potentially match a percentage. That's where you get into safe harbor rules. I'm not here to get into where they can match 3, 4, or 5% of your contributions. Number 3, the investment options are typically involved in mutual funds, ETFs, and other investments that go up and go down, all right, depending on the plan sponsor within that person's 401k. But here's the question. What about distributions? Distributions, since they've never will be taxed because the contributions as well as the growth on that has never been taxed. And then at age 72, you must start taking them at age 72. This is also important to recognize. Principal is not protected, meaning the market goes up and the market goes down. No guarantee of return or performance. That's your foundation for understanding 401ks. The advantages, both employers and employees can make retirement plan contributions on a pre-tax basis. People love it for that reason. The employee directs has his or her 401k account is invested and assumes the risk of investment performance. Potential for match funds from the employer. Those are the 3 reasons why people use 401k for savings for their retirement. Disadvantages, obviously they tend to be more advantageous for younger employees. Why? Because they've got time. Think about the compounding effect, the rule of 72, however you want to think about it. If I've got 10 years before retirement versus 40, that's a different conversation. They take the risk of the investment decisions and on income distributions. But here's the killer, the fully taxable at distribution. So with that in mind, let's do a little, how can you help grow your retirement income? Because this is what we're looking at. Here's a case study. I'm talking about the 40-year-old. He's thinking pretty good. Hey, I haven't saved for my 401k yet for my retirement. I have nothing in there, but I'm 40 years old. All of a sudden, I woke up and started to, look at my deal and say, I need to start saving money. So if this 40-year-old, and I did it for simple illustrative purposes only, said, I'm going to max out and put away $19,500 for 25 years. Yes, I know in 10 years you can increase it to 26, but let's just keep it simple. $26,500 for 25 years into his 401k. Now the question becomes, what happened there? Well, when he puts away $19,500, he's reducing his income, therefore he's reducing his tax liability. So in that 25 years, he's going to save $162,500 in taxes. Okay, that's the good news. But then it's $487,500 is contributed, and with a 7% return, he's got somewhere a little over 1.2 million in his 401k. Pretty vanilla stuff. Well, that's going to give him what he wants. He wants an income. That's why he saved it. So they're going to they're going to say, okay, start sending me $100,000, and assuming a 35% tax bracket, which is not that unusual as we look at taxes going up, I believe, he's going to pay $35,000 of taxes on that 401k. So they estimated if he lives between 65 and 90, he's going to have all those, he's going to have $2.5 million of distributions, and he's going to have the pleasure before he dies of having paid the Internal Revenue Service $875,000 in taxes. Look at the top. He saved $162,000 during his working years by putting money in the 401k, but in exchange, he now has a tax bill approaching $900,000. Ouch. Well, what are we suggesting? Here's what we want you to start thinking about. These are the key words. Go back to that last slide. He has nothing in the 401k. He's contributed at 19.5. So he's saving $162,000, $500. Write this down, folks. Does your client have a plan for retirement income that includes a plan for paying the taxes? Most advisors out there, when they're dealing with investments, usually only deal with 3 buckets. Two buckets. Bucket number 1 is the retirement bucket. It's going to save on a tax-deferred basis. The other one would be the individual brokerage account or savings account. But rarely do they have a 3rd bucket, which is the tax-favored basis or a tax-free distribution to pay the tax liability on bucket number 1. So we're going to direct a portion of the $162,500 to a leveraged retirement account that we're going to pay $30,000 a year for 5 years. Let's keep this simple, folks. If he's saving $6,000 a year for the next 25 years, he's going to save roughly $150,000. I want him to save, get this phrase, I want you to direct your clients to save their tax savings. That's all we want them to do. And we're going to save that in the most efficient way using Kaizen. So he'll pay $30,000 a year for 5 years into the Kaizen plan. He'll have $487,000 between 65 and 90. He'll have $487,000 contributed. He's going to have 1.2 in there. He's going to have $100,000 of income. And the estimated total taxes are going to be 401. But here's the key. All right. The $100,000 will create $35,000 of taxes to be paid. Does he have a tax plan to pay that tax liability? What we want to do by the Kombo Plan, he'll have $70,000 of tax-free income coming from the Kaizen plan. And in doing so, $70,000 comes in tax-free. So when the $35,000 tax bill comes due at 65, you've got that prepaid and you've got in excess of $35,000 of tax-free income. So you're increasing the income at retirement as well as creating a tax-free payment system, utilizing the $70,000 of extra income to pay the taxes from the 401k. I submit to the audience out there, you've got a handful of clients to ask them that question. I know you're saving for retirement. Do you have a plan to deal with the taxes at retirement on all those deferred taxes that you currently have, whether it's in your 401k, your IRA, your Keogh plan, and others like that? I suggest not. This is where Kaizen kicks in. So with that in mind, let's take a look at Kaizen. What is it? Well, the key here is a Forbes magazine. You can leverage your way to riches. I mean, I think back to the, for those who do or do not like our boy Donald Trump, I found it fascinating when he bought the Trump casino down in the Atlantic City, he contributed less than 1% on a multi-million-dollar project, but he put his name on it. That's the ultimate leverage. We want to do a similar leverage situation so that you can grow your assets. How do we do that? First off, let's look at the Kaizen program. What is it? To begin with, the minimum contribution is $21,350 through age 48. So that 30-year-old, that 40-year-old could put away as little as $21,350, and then we'll solve for the death benefit. All right. Now, when you get 48 and older, that number of minimum contributions rises. It rises in incremental basis, 48 versus 52 and so forth. So you'll have to look at those specific numbers, but letting you know that you have the ability to contribute to a Kaizen plan at 48 and younger with as little as $21,350 for only 5 years. It's funded with after-tax dollars. The bank matches the contribution approximately 3 to 1. So let's keep it simple. You put in $30,000. The bank's going to match roughly another 30, so 60,000 goes in. Now, we get into investment options. They're going to utilize an Indexed Universal Life Status program where we're going to have no loss of income. We can get tax-free distributions from this. We can get no mandatory starting date. So we can start it as early as 65. We can start it as, or maybe not start it at all. It's up to you, in which case the death benefit would be higher if you don't take any distributions. We have the potential for growth based on market index. And the key here of index investing is protection from market declines with a zero floor. What else? Kaizen was uniquely designed to take advantage of leverage by combining it with cash accumulation features. And in doing so, all right, the perfect example of leverage. We go into this, I can read all those words on this slide. The simple one, talk to your client about this. He's got $100,000. He likes the potential of growth within real estate. So he takes his $100,000 and he buys a home. And that home grows it appreciates by 10% a year from now. So his net worth has increased by $10,000. Simple, basic math. On the other hand, his other partner goes along and says, I'm going to take the $100,000. I'm going to buy a $400,000 home because I'm going to get $300,000 in the form of a mortgage. So now I got a $400,000 home versus the original guy who had $100,000. Well, both homes appreciate by 10%. The second person who used leverage has his net worth increased by $40,000, not $10,000. Multiply that out over years, you can see exactly what's going on. So using up to 3 times more money in your plan is where this leverage program works. And by putting in an efficient model using indexing and the tax-free nature for tax-deferred growth in a life insurance policy gives us the ultimate way to save for retirement. Potential benefits. Now, we all know that we put this together for a 40-year-old. There's a possibility he could die. Well, we got a death benefit associated with it, somewhere in the 1 million range, 1.2 million. He could also get hurt along the way. So it's got a chronic illness distribution capability. It's got terminal illness protected, which is a whole lot better than a self-funded plan where the benefits will only be what he saved. And when we do distributions, because we're using a Kaizen plan, the income will be generally 2 to 3 times larger because of 2 to 3 times of contributions. It's just simple math. So Kaizen uses leverage and using tax-deferred accumulation. Now, let's talk about the cap rate. The cap rate is set up in such a way that it's challenging. AG 49A, for those on the call today, will recognize that. What they've done is some of the numbers were looking too good, too impressive. So AG 49A suggests that we need to illustrate a lower interest rate. So we've got expenses coming off the one hand, we've got growth coming on the other. What's interesting to me is looking at historical, a 15-year look back versus a AG 49A. As an example, Allianz has a product, they're using their index product. They have an illustrative max, according to AG 49A, of 6.03%. Yet their 15-year historical look back is 8.02. Think about that for a moment. It's essentially a 2% difference. Why is that important? So when we illustrate something, similar kind of differences between National Life in terms of National Life has a spread of a little more than the point, but the point of the story is you're illustrating lower conservative numbers than history would have credited to that account. That's an important understanding of how index can work. Now, to make that point, let's consider this. How it can grow, it's going to grow. My guess is when you do your 5-year and 10-year reviews with the Kaizen policy, my guess is because of historical returns being the actual credited to it, it'll be even a higher number that's in the cash value in the policy than the projected one, because we're forced to project a lower interest rate through the AG 49A. How does the strategy work? Your contributions are combined with lenders and paid into the policy. So we've got cost there, we've got expenses, but they represent less than 1%. On average, it's about 0.67%. 2/3 of 1% is going to go towards expenses. So therefore, make it simple, if you got a 7.5% return, you got approximately a 6.75% return on the actual cash value, because 75 basis points or so went to the internal charges, the mortality and other expenses that go with it. So that's what makes it work. It's a great investment because of the efficiency of how it all works. And then we get into leverage. We've all seen this chart, how it works, where in year 1 through year 5, the clients put up his money. In our example, we're going to show you, it's $30,000. And then the banks come along and give you something close to $30,000. That number is a little less only because of AG 49A rules. But what happens? Let's call it 30 as well. So in years 6 through 10, the client puts in nothing, and a full nearly $60,000 gets placed in that account with the client's name on it. And the only collateral that is required is the policy itself. That's what makes this so attractive. Go back to our original examples, the premium financing cases. We needed outside collateral. We needed the client to pledge personal assets. Whereas in Kaizen, there is no pledge using personal assets. The policy is self-contained, if you will. That alone gives us the ability to get leverage with very little risk to the client. That leverage makes this thing work. But also in terms of how the growth is protected. We talked about a floor. That let's say it goes up by 6% this year. The following year, it goes up by another 6%. But it's 6% on the 106 now, because the 106 never goes down. The following year, the market has a negative return. We're still going to be in our example here of 106 to 112. And if the market dropped, the 112 is still there. Yes, you've got a 0% return. The old cliche is 0 in this example is my hero, because I don't have to dig out of a hole. Do the math. You watch how interest rates go up and interest rates go down. You need simple math. You have $100,000 and it goes down by 10%. Well, now it's down at 90. In order to get back to even, you got to earn 11% the following year. That's where simple math comes into play. By never having to climb out of the hole, the growth on the index account really sings. Now the enrollment process. So you have to determine how much you want to contribute per year. Then you talk to we'll get the illustrations for you. You can reach out to John Countryman, reach out to me, help you give a specific customized illustration saying, I got a client who wants to contribute $32,000 a year. Here's his age. I'm guessing that his underwriting is standard or preferred. And then we run the illustrations accordingly. And then we submit the application. A formal app goes in. When your underwriting is approved, you'll be notified of the approval and be prompted to complete an electronic form to establish a trust. Because there is a master trust. Let me go down one little point with you. In order to get optimum, that is the lowest interest rates policy on the borrowed funds that's complementing your Kaizen plan for your individual, they create a master tranche, and it's every 2 to 3 months that gets established. So your client may be putting in 30 and therefore borrowing roughly 30, but there's going to be 100 others. So therefore the amount borrowed gets into the millions. And in doing so, what do we get? Efficient, low-cost interest by the banks. Banks love this deal because you've got cash value protecting their investments. So they've got guarantees as far as they're concerned of proper collateral on this deal. But they established this master trust, and then your client has a sub trust within that master trust, so that they get the advantages of the lowest interest rate possible. The policy is used as collateral for the bank loan. The trustee monitors. Banks love this. The banks go to the feds and borrow money. Let's make it easy at 1%, and turn around and loan the money to your client at 3%. A 2% guarantee to a bank is huge in their world. So that's why they got they used to have 12, and they now have 13 national banks funding the Kaizen plan. There's over $6 billion, that's with a B, $6 billion funded through the NIW program in Kaizen to make sure that it's always there. The bottom line is it's working. We've got big banks behind us. It's a model that banks are standing in line to participate in. So that works. That enables to keep the interest rates down. So the performance, that spread between borrowing money at say 3% and earning 6% in the index, is what makes this thing so attractive. Now, what do the private bank life insurance magazines say? Kaizen is the most compelling option I have seen in my search for a solution to maintain my current lifestyle in retirement. Banks have reviewed this. People who deal with money have reviewed this. Now, let's take it one step further. Case studies, in my opinion, drive home the story, how it all works. All right. So we've got the early starter. The guy says, look, I've been working the last 10 years. I put money aside. I've got $300,000 in my 401k plan. I'm feeling pretty good about retirement. All right. And he's deferred $162,000 in taxes. Good for him. The question is, does he have a tax plan? The good news is, since he set aside $300,000 already, and he contributes another $19,500 for the next 25 years, because he's got a running start with $300 already in his account, look what that account grows to. By the time he's 65 years old, he now has approximately $2.8 million in his 401k. He's leaning back in his big easy chair and grinning, saying, yeah, I got $2.8 million in my 401k. And then I throw water on him and say, yeah, you got $200,000 of income coming from that, but you also got $70,000 in taxes to be paid. And if you live to age 90, you're going to have the pleasure of paying $1.7 million in taxes, $1,750,000 in taxes. How do you feel about that? Let's see if I got this right. You saved $162,000 for the privilege. And there's your smiling saying this, so you can pay $1,750,000 in taxes. Hey, early starter, you have a tax plan to pay that $1.7 million? What if I told you we can do a Kaizen plan, whereby that $1.7 million tax bill is going to be paid with your tax savings? Work with me for a moment. He's put away $19,500 for 25 years. He's deferred $162,000. We've directed a portion of the $162,000. In this example, $30,000 a year for 5 years. So we've taken his tax savings, and novel idea, we saved it. We saved $150,000, but we saved it in the Kaizen plan. Why? Because of leverage, because of the protection on the downside risk in index investing, with matching funds and so forth, and tax-free distributions, because it's under Section 101G of the IRS code. He can get tax-free distributions. So now, when he has $200,000 of income each year, with $70,000 of taxes to be paid, he's going to get $70,000 tax-free income each year until age 90. And then he can use that $70,000 tax bill shows up, $70,000 Kaizen distribution shows up. We've now prepaid his taxes. He set aside $150,000 today so that he can save so he can prepay the $1.8 million tax bill in the future. The idea is, knowing that tax bill is coming, create that third bucket. Ask your question. Ask the client, ask your client, your prospects, do you have a plan for taxes in retirement? If not, call me. We'll give him one. He'll like the efficiency of all of this. Now, are there any questions relative to what we talked about? Yeah, we're right on time.
Yes,
We
actually,
can
Bob,
open.
yeah, I do have several. And one of them I think you touched on with the zero is your hero reference. But let me just read the question to you so you can expand if you wish. Relative to the insurance vehicle used for funding, why use index life versus variable?
Well, first off, the obvious question, the answer is I like the efficiencies of an index UL and the guaranteed floor combined with the facts, but you cannot borrow money to find a VUL. So I've got the SEC regulations pushing back on that as well. Whereas an index product, despite an efficiency in the range of 5, 6, 7% returns, therefore equating to approximately what a VUL would pay, I don't have the SEC regulations looking over my shoulder. Like that, I can't do it for one, and B, I'm going to get similar return because of the efficiency of the floor.
Yes, thank you. Relating to the actual Kaizen plan or to the program, does Kaizen provide any protection against creditors?
Yes, because because the investments are in a life insurance policy. The only creditor that you'll have will be the bank that Kaizen has set you, the NIW has set up in the Kaizen plan of the lien against the policy, because we've loaned you. In our example, you put in 30, they've loaned you 30. That's the only quote creditor is that bank lien. But the cash itself in there, particularly after year 15, is 100% the client and creditor protected.
Yes, that's good. Keeping with that thought, are the Kaizen loan rates more competitive than the consumer going out getting their own loan, that is?
Without a doubt. And that goes back to that whole master trust that's set up in, like, they set up about 6 or 7 a year, depending on the demand, if you will. So now they're going to go to a bank and say, we've got this guaranteed money supported by the cash value in insurance companies, and well-known and respected insurance companies like Allianz and National Life, A+ rated carriers with AM Best. We want to borrow against the cash value. Banks love this deal. So therefore, they give them the lowest possible interest rates, somewhere in 2.7 interest rates. I don't know of any interest rates on a personal loan basis where you can borrow money that low.
Right, that's probably very true. Last question, Bob, if you have one more moment, is
Sure, fire away.
Back to the indexed UL plan itself. Who within the plan selects the indices that the contributions are connected to, really?
Well, the client would, but we strongly encourage you to have conversations with your clients and direct them as their advisor where to put it, right? For example, in the Allianz, the Bloomberg US Dynamic Balance 2 indexed annual point to point over the last 15 years has an 8.02% return. Past performance is no guarantees of future, but we get the idea. However, because of AG 49A, and this is an important distinction, the max interest rate in an Allianz proposal is 6.03, near almost 2 points lower than the actual historical returns. Why is that important? Well, the plan we use an example of a 40-year-old, so therefore we got a 50-year time frame. 25 years of growth and 25 years of distribution. To point out the difference of what 2% can look like, if you had $100,000 now and you didn't touch it for 50 years and you got that 6.03% rate of return, that 100,000, here's the good news, is going to grow to $1.7 million. Isn't that great? However, if you got the actual 8.02% credited to that 100,000 in year 50, it'd be worth 4.7 million. It's only an extra 3 million in your account. The subtle differences of interest rates compounded over this 50-year period of time is enormous. That's why I give this as an example. So that's why I'm a big fan of indexing. I'm, in some ways, thankful that the AG 49A rates are lower, because if I show you a cash value projected of, pick a number, $102,000 in year 10, and it actually is $112,000 in year 10, I'm getting hugs and kisses all the time. Get the point? So the lower interest rates, while they may not look as sexy as they have been in the past, the actual performance based on historical returns and my 40-year history in this business should be actually a little bit higher. That's my personal assumption because of the historical look back we just talked about.
All right.
If you want to talk about that further, let me know.
That's all good news, Bob. Thank you. I think that's all we have for now. Like I said,
Okay, wait a minute, Maureen, can I give you one last point?
Absolutely, please do.
Because there was a case opened up recently with one of the reps, and we talked about Kaizen. I just want to give one other 2-minute commercial for Trizan for the right clients who've got either a C Corp or they work for a nonprofit. We can do all this Kaizen leverage and do it on a pre-tax basis and still get tax-free distributions on the back end. So if you've got the client that fits that profile, call me where we can take Kaizen a notch above by making it pre-tax on the contribution. Keep that in mind.
It's good news. It's a great opportunity, really. And again, I'll encourage you to either contact us here and let us know that you have clients you're interested in presenting this to, and of course, working with Bob at any point in time. We would love to see you team up with him. As you can tell, he's very clearly experienced in this opportunity. So I have one more question, is where to get an illustration for the case, for any case, and I suggest that you call 800-524-1774 and ask for John Countryman. And Bob, you're going to put your phone number up, and of course, we'll be calling all of you because we love the fact that you joined us. So, Bob.
There you go. There's my contact information.
All right, there we go. Yes, please, of course, Bob, you'll communicate with us if anyone needs anything from us as well. And we will be in touch. So thank you, all of you, for joining.
Thank you.
Thank you, Bob.